How the Tether and Circle really make money. The invisible 13 billion printing press. The shocking premise, the invisible money machine. Imagine a company that in 2024 reports a net profit of approximately $13 billion. Now imagine this company has only 100 employees. For comparison, let's look at BlackRock, the world's largest asset manager, a Wall Street giant with over 21,000 employees. Their net profit for the same year, 2024, was only $6.4 billion. Let's pause for a second and let's sink in. A cryptocurrency company with 100 employees earned twice as much as a financial titan with an army of analysts, managers, and lawyers. If you calculate the profit per employee, Tether comes in at around 130 million, while BlackRock is about 300,000. That's a difference of over 400 times. This brings us to the main question of this video. How does a company that simply issues a stable digital dollar, supposedly pegged one-to-one with the real dollar, manage to generate such colossal sums of money? Where does this profit come from? I'll tell you right now. It's not from transaction fees. The mechanism is far larger and more interesting. Today we are going to break down the two giants of the stablecoin market. On the one side, we have Tether, or USDT, the oldest, largest, and most controversial player in the field. On the other, its main competitor, Circle, the issuer of USDC, which positions itself as a regulated, transparent, and secure alternative. Both aim to maintain their tokens' value at $1. But their philosophies, their approaches to managing reserves, and most importantly, how they generate profit are radically different. In this video, we will expose the differences and show you how this secret money machine actually works. This isn't just a story about efficiency. It's about a completely new, hyper-scalable, and low-cost financial model that until recently existed in a regulatory gray zone, allowing it to achieve unprecedented profitability. The core mechanism, the world's largest interest-free bank account. To understand how they make money, let's use a simple but very accurate analogy. Imagine you deposit $100 into a special bank account. The bank guarantees that you can withdraw your $100 at any time. But there is a catch. Usually there is a catch. It pays you no interest. Instead, it takes your $100, invests it, and keeps all the profit for itself. Now, imagine this bank holds not $100, but a combined total of over 200 billion. This, in a nutshell, is how Tether and Circle make their money. When a user buys one USDT or USDC token, they are essentially giving the issuer one real dollar.
There it is! It's beautiful! Take your hat off, boy, that's a dollar bill!
The company places this dollar into its reserves, a giant fund that is supposed to back the value of all issued tokens. The golden goose, US Treasury bills, and the perfect storm, the primary asset that makes up these reserves, is US Treasury bills, T-bills. These are short-term government debt securities, considered one of the safest investment instruments in the world. And right here, a perfect storm of three factors converged for stablecoins, leading to an explosive growth in their profitability. First, massive scale. The cryptocurrency boom led to the issuance of hundreds of billions of dollars in stablecoins. This created a gigantic pool of reserves that fell into the hands of the issuers. Today, Tether's reserves exceed $157 billion, and Circle's are over $65 billion. Second, soaring interest rates. As a part of its fight against inflation, the US Federal Reserve sharply raised its key interest rate. This directly increased the yield on the very same T-bills that Tether and Circle hold. To give you an idea, the yield on 3-month T-bills went from practically zero to over 5% per year. Third, simple math. Let's do the math. $100 billion in reserve, earning 5% annually equals $5 billion in annual, virtually risk-free income. This is the core of their business model, the printing press. This model isn't just a bank. It's a new type of financial organization that combines the deposit-taking function of a bank with the investment profile of a money market fund, but without the key regulatory obligations of either. Banks are required to pay interest on deposits and contribute to a deposit insurance fund. Money market funds pass the yield onto investors, retaining only a small management fee. Stablecoin issuers until recently got the best of the worlds. They accepted deposit-like bands, paid no interest, and they invested them like funds but kept all the profits for themselves. This is the real secret. Secondary income source. Fees for the selected few. Of course, they don't only earn money from interest. They have a secondary source of income. Fees. But these aren't the fees that everyday crypto users encounter. Issuers charge for the direct creation, minting, and redemption, burning of large batches of stablecoin. Their clients are mainly cryptocurrencies exchanges and large institutional traders. For example, Tether charges a redemption fee of 0.1% of the amount for a minimum of $1,000 for transaction over 100,000. Circle has a more complex tiered fee system that kicks in for redemptions over 2 million per day. However, it's important to understand that this income stream, while significant, is secondary to the enormous interest income from their reserves. At the Great Divide, two titans, two philosophies. Although the basic business model for Tether and Circle is similar, their approaches to implementing it are night and day. How they manage their reserves defines their essence, their risks, and their future. This is a battle of two ideologies, two visions for the future of money. Circle, USDC, the path of compliance and transparency. The strategy of Circle, founded in 2013 by Jeremy Allaire and Sean Neville, can be described by the motto, trust through transparency. Their goal is to become the stablecoin of choice for large institutional investors. And for that, crystal clarity and full regulatory compliance are essential. The clean reserve. USDC reserves are designed to be as simple and low risk as possible. They consist exclusively of cash and short-term US government obligations. A key element of their strategy is partnership with giants of traditional finance. BlackRock, the world's largest asset manager, which manages the majority of USDC's reserves through the special SEC-registered fund called the Circle Reserve Fund. BNI Mellon, America's oldest bank, which serves as a primary custodian or asset holder for this fund. The announcement of this partnership in March 2022 was a landmark event for the entire industry. The composition of the Circle Reserve Fund is public. It's mainly US Treasury securities and reverse purchase agreements collateralized by those same securities. In addition, Circle publishes monthly attestation reports from a Big Four auditing firm, Deloitte, which confirms the composition and sufficiency of the reserves. The near-death experience, the depegging due to SVB. Despite all this transparency and security, in March 2023, Circle experienced its worst nightmare. Silicon Valley Bank collapsed, and the company was forced to admit that 3.3 billion of its cash reserves were stuck in the failed bank. Panic gripped the market. Fear arose that Circle would not be able to honor all redemptions at the 1-to-1 peg. A massive sell-off of USDC began, causing its price to crash to 87 cents. It was a devastating blow to the reputation of the safest stablecoin. So how was the peg restored? The US government stepped in. It announced it would guarantee all deposits at SVB, which meant Circle would get its money back in full. It was this action, not any effort by Circle itself, that restored market confidence, and the price of USDC quickly returned to the dollar. This incident was a harsh lesson in counterparty risk. It showed that even the most conservative model can fail. Ironically, the connection to the traditional financial system, which was Circle's main advantage, also proved to be its critical vulnerability. Tether USDT, the path of opacity and profit. If Circle's strategy is trust through transparency, then Tether's approach, founded in 2014 as real coin, can be characterized as move fast and maximize profit. They prioritize market dominance and profitability, often at the expense of transparency. The black box reserve. Unlike Circle's clean reserves, the structure of Tether's reserves is far more complex and opaque. Let's look inside their attestation report. Cash and cash equivalents. This is the largest portion of the reserves, but the most interesting parts lie elsewhere. Secured loans, approximately 8.2 billion. This is a huge and the most controversial strategy. Essentially, Tether acts as a large, unregulated crypto bank, issuing loans to other companies against liquid assets as a collateral. Who these borrowers are and the quality of the collateral is unknown. An example of this risk is their past loan to the now bankrupt company Celsius. Bitcoin. Bitcoin, approximately 7.9 billion. Tether holds billions of dollars worth of Bitcoin on its balance sheet, purchased with a portion of its profits. This adds significant volatility to their asset base. Precious metals, approximately 5.3 billion, mostly gold. Other investments, approximately $4 billion, a completely opaque category that could hide anything. A history of controversy, lies, and the attestation game. A key moment in Tether's history was 2021 settlement with the New York Attorney General office. The office conducted an investigation and came to a conclusion that, in its own words stated, Tether's claims that its virtual currency was fully backed by US dollars at all times was a lie. Here are the main findings of the investigation. There were periods when Tether had no access to banking services at all, meaning it had no reserves to back the tokens. They covered up a loss of $850 million by secretly taking money from Tether's reserves to patch a hole in the balance sheet of its sister company, the exchange Bitfinex. In the end, Tether paid an $18.5 million fine without admitting guilt, but it was ordered to begin publishing quarterly reports on the composition of its reserves. And here we come to the attestation game. It's crucial to understand the difference between an attestation and a full audit. An attestation, which the firm BDO Italia conducts to Tether, is merely a snapshot of assets and liabilities on a specific date. An audit is a much deeper and more comprehensive review. Critics argue that Tether uses attestation to create an illusion of transparency, especially after the New York office found that they had specially moved funds into accounts right before a check to show the required backing. The profit paradox. So why is this riskier model so much more profitable? It is simple. The yield from secured loans and the potential profits from Bitcoin's price appreciation are significantly higher than the yield from ultra-safe treasury bills. This is their main trade-off: more risk in exchange for much greater profit. The battle between Tether and Circle reflects a fundamental ideological conflict within the entire crypto community. Crypto anarchism versus institutional adoption. Tether, with its offshore registration, avoidance of the US regulators, and close ties to unregulated exchanges, embodied the early cypherpunk ethos of cryptocurrencies. Its motto is "Trust us, the code, and the market." Circle, with its US headquarters, pursuit of regulation, and partnership with BlackRock and BNY Mellon, represents the new wave seeking legitimacy in the eyes of traditional finance. Its motto is "Trust the auditors, the regulators, and the law." Their reserve management strategies are a direct consequence of these philosophies. Tether reserves include Bitcoin and opaque loans to other crypto players, keeping capital within the ecosystem. Circle's reserves are held by BNY Mellon and managed by BlackRock, outsourcing the function of trust to the very institution that cryptocurrencies originally set out to disrupt. The question of how they really make money is inextricably linked to the future they are building. The future is regulation. The walls are closing in. The Wild West era of stablecoin is coming to an end. Governments around the world are stopping their sideline observation and starting to create concrete rules for the game. Two pieces of legislation are changing everything. The first is MiCA, Markets in Crypto Assets, in the European Union. It has already come into force and set strict requirements for issuers. They must be licensed, undergo audits, and hold reserves exclusively in highly liquid assets. Major exchanges like Binance and Kraken have already begun delisting stablecoins that do not comply with MiCA for European users, with USDT being a primary target. The second is the Genius Act in the United States. In our scenario, let's imagine that this bill has recently been passed. It creates a federal regulatory framework for stablecoins. How exactly does regulation change the game? It strikes at the very heart of their business models. Strict reserve requirements. The new laws mandate that reserves must be 100% composed of cash or very safe short-term government securities. This effectively bans the use of assets like secured loans, Bitcoin, or other risky investments as primary backing. Custody and transparency. The laws require assets to be held with regulated custodians and demand regular, transparent reporting and full audits. In this new reality, there are clear winners and losers. Circle comes out ahead. This regulatory future looks exactly like the business model they have already built. Their conservative reserves and partnership with BlackRock and BNY Mellon mean they are compliant with most requirements by default. For them, regulation is validation of their strategy. For Tether, it is an existential threat to their current hyper-profitable model. They will be forced to sell their riskier and higher yield assets, those loans and Bitcoin, and become much more transparent. This will likely slash their profitability and force them to compete with Circle on a level playing field. The ultimate competitor, Central Bank Digital Currencies, CBDCs. But there is another, longer-term shadow looming over the entire stablecoin industry. Central Bank Digital Currencies, or CBDCs, a digital dollar issued directly by the government, or euro, whatever. Already, 137 countries, representing 98% of global GDP, are exploring the launch of CBDC. This is the main long-term competitor. Why use a private digital dollar when you can use an official one, 100% guaranteed by the state? Conclusion: 2 paths, 1 future. So, let's recap our journey. We started with a shocking profit figures and discovered that behind them lies a simple but brilliant idea: earning interest on giant interest-free deposits. We saw how this idea gave rise to 2 radically different philosophies. Tether chose the path of opacity, risk, and maximum profit, becoming a titan of the crypto-native world. Circle followed the path of transparency, compliance, and institutional trust, building a bridge to the world of traditional finance. On each of these paths, their own disaster awaited. Tether faced a regulatory reckoning with the New York Attorney General, while Circle faced market panic during the SVB collapse. And now, as the walls of regulation are closing in, the game is changing. Tether's high-risk, ultra-profitable model is under threat, and Circle's slow, steady, compliance-focused strategy is about to be rewarded. Which path will prove more sustainable in the long run? Can Tether adapt and survive, or will Circle become the undisputed king of regulated digital dollar? The answer to this question will not only determine the fate of these 2 giants, but will also largely shape the future of the money itself. What do you think? Is Tether's dominance too big to fall? Or is the path of a compliance chosen by Circle the only right one? Write your opinion in the comments below. And if you enjoy deep dives like this, be sure to subscribe to the COREDO channel. Thanks for watching.